Welcome to question number 10. How much money do I need to trade Forex? This is not a very easy question to answer for each individual trader. As starters, due to the higher levels of leverage, most Forex brokers have a very low entry level, allowing traders to commence trading with accounts as low as $100. Now, this in itself is not a problem, providing the trader has a broad perspective of the market and has relevant risk management knowledge. Let me try to explain what I mean. Assuming the trader has $100 in their trading account, chooses to only risk 1%, which is $1 on every trade. Now, that's a good advice, by the way. Now, this trader finds a trading opportunity with stop loss of 20 pips. The trade size will be 0.005 lots. You will notice that the minimum trade size on most brokerage platforms is a micro lot, which is 0.01. Now, based on calculating the trade size of 1% on $100, comes out to 0.001, which means that trader cannot trade. Now, for the trader to trade 0.01, it means the trader will then be risking $10, which equates to 10% of their trading account, just simply because they have a small account. Now, if it was $1,000 in that account and they risk 1%, 1% of $1,000 is $10, which means the trader can trade the minimum trade size without exposing their account to higher levels of risk. Therefore, with smaller accounts, there is higher risk of loss simply due to basic trading conditions, not because the trader is against them or the market is against them, but just because of maths. The other reason why small accounts are susceptible to higher risks is due to the concept of margin and leverage. Now, most brokers will provide margin accounts to retail traders. With a margin account, the broker lends the trader cash to purchase currencies. Cash in the trader's account is used as a form of collateral. Since the trader is purchasing currencies with the broker's cash rather than theirs, the trader is using leverage to magnify both gains and losses. For every trade open, there is a minimum amount of margin or minimum amount of equity, which is known as margin, required to have that trade open. Most Forex brokers will provide leverage of up to 1 to 400. Now, my recommendation is to not go more than 1 to 100. If you can even use 1 to 50, that is better because you limit the amount of hit you get on losing trades. Margin is determined by the trade size, which is the number of lots, and the leverage on the account. And now let's take the first example. What is the margin required for one standard lot of Euro USD at current price of 1.29968? Now, one standard lot of Euro USD at price 1.29968 is equivalent to $100,000 euro over $100,000 times 1.29968, which is $129,968 of USD. For a leverage of 1 to 100, the margin required will be equal to the notional value times the leverage. So the notional value in this case is 129,968 times leverage 1 over 100, which is 1,299.68. This means the account must have a minimum equity of 1,299.68 to be able to sustain a 1.0 lot Euro USD. So that's a one standard lot. So if we just went down to 0.01 lot, which is a micro lot, you just divide that by 100. So it means that the trader will need to have a minimum of 12.99, so $13 in their account of $100 to be able to sustain an open trade. It is important that the trader understands and applies this concept. For example, if one standard lot Euro USD trade is open and the account equity drops below the required minimum margin, if the trader fails to add more money into their account to increase equity above minimum margin, the broker will immediately close the open position at the current loss. This is what is referred to as margin call. So we've just talked about this. A trader has an account of $100 in it, and the margin required for one micro lot is about $13 plus or minus. So if the trader has 5 trades open and each trade has got one micro lot, you'll be looking at about $65 in margin required on that account. Now, take away $65 from $100 and you just have about $35 to go. This is exactly why the trader with a very small account is already losing the battle before they even start, because there is nowhere they can go. They have not given their account enough room to breathe. And the market doesn't go in straight lines. The market goes up and down. So you must be able to give your account some breathing space. Just for the sake of account size, there is an increased potential for loss trading smaller accounts less than $500. Ideally, a small account should not be less than $2,000. My opinion. Smaller accounts can be used, but consideration should be given to liquidity, required margin, trade size, trade stop loss, and targets. And that really is my take on this. You can use small accounts, but to become successful, you've got to start thinking about some considerable account size to be able to beat the ebb and flow that one finds in the market, the default state of the marketplace. I hope that helps you, but please feel free to request for further clarification, and I will be delighted to support you. All right, cheers.